Steve here. The opening bell just rang. And look, let me tell you straight out of the gate, most of the retail crowd out there is dangerously misreading the morning tape. They're staring at their screens, throwing a massive risk-on party right at the 0 hour of the Sunday storage deadline. Welcome to today's Explainer, where we're going to break down the cold hard numbers. Because while the headlines are screaming about new geopolitical proposals, the tape itself, well, it's telling a much more violent story. If you aren't paying attention to the clock, the charts, and the physical reality of what's happening globally, you're not investing, you're just gambling with your life savings. Let's strip away the illusion and look at the actual data.
Take a hard look at this divergence right here. On one side, you've got the S&P 500 attempting this defiant, almost stubborn stand, clinging to a record high of 7,165. It's kind of fueled by blowout corporate earnings and, honestly, desperate hope. But look at the beast right next to it, Brent crude. We're watching a violent rip past $108 a barrel. It touched intraday highs near 110. This massive divergence between paper equity assets and the physical energy market is absolutely at a breaking point. One of these charts is lying to us. And in my experience, physical energy rarely bluffs.
Let's run through the opening ledgers so we can see the whole board. You see the S&P holding that record, and Brent just ricking up over 2.8% today alone. But check those bottom two rows. Look at gold. It's taking a really heavy sell-off, consolidating down at 47.10. And Bitcoin, we saw a knee-jerk reaction up to 79,000 on weekend news, but then it suffered a violent pullback down to 77.7 as the global reality finally set in. The smart money is repositioning, guys. The momentum is fracturing right in front of us.
Now, focus your eyes on this single number, positive 145. That is your 20-period Commodity Channel Index, or CCI. It is printing a massive, and I mean massive, overbought reading. Look, in my 30 years on the floor, you learn to respect the mechanics of the market. When you see a triple-digit CCI pinning the needle like this, it is waving a giant red flag. Momentum is stretched to the absolute limit.
And it's not just the momentum, it's the price itself. Right now, we have an 11% gap above the 200-day simple moving average. Your ultimate floor sits way down there at 6,696. Trading this far above that floor establishes a historical technical zone for a violent mean reversion snap. Think about stretching a heavy rubber band to its absolute breaking point. When it finally lets loose, it doesn't just gently float back. No way. It snaps back. Hard. And that is the exact technical precipice we are standing on today.
Section 1. The red folder, manufacturing, and liquidity.
So this is the red folder window. This is where the cost of living violently meets the cost of capital. Keep your eyes glued to these 3 data drops today. First up, the Texas manufacturing outlook. The street is hunting for confirmation that industrial sectors aren't buckling under the weight of $100 oil. If this data misses that whole soft landing narrative, it's dead. Second, overnight SOFR liquidity is drying up fast. And finally, the Treasury auctions for 2-year and 5-year notes hit today. Listen to me closely. If auction demand isn't there, yields are going to rip higher. And if yields rip, that record high S&P has a very long way to fall.
Section 2. The catalyst. The Hormuz standoff.
So what's driving all this massive structural tension in the first place? Well, it's the total breakdown of geopolitical expectations over the weekend. On one side, Tehran has offered a proposal. They reopened the Straits of Hormuz in exchange for lifting the blockade, pushing any nuclear talks to a later phase. But on the other side, the U.S. Navy blockade remains in absolute full force. The White House has laid down what we're calling the power plant ultimatum. Clear the waterway unconditionally or face a total decapitation of Iran's domestic power grid. Literally, 2 completely opposed positions colliding in real time.
And that leaves us right here, with a totally binary market. Deal or dark grid. Right now, the market is trading on the hope of a ceasefire that simply hasn't been signed yet, while the U.S. blockade remains impenetrable. This is the very definition of binary risk. If that proposal leads to ink on paper, one thing happens. But if the grid goes dark, we enter a completely different universe. There is absolutely no middle ground here.
Section 3. Bull versus bear scenarios.
We absolutely have to map out our parameters over this geopolitical powder keg. First up, the bearish case. Let's call it the Hormuz mirage. If that hope evaporates, if the grid is actually struck or the blockade tightens, that record high in the S&P 500 is going to vanish. Remember, Brent crude has already ripped 17% in a single week just on anticipation. If the worst happens, regression back toward the 50-day exponential moving average floor down at 6,781 will be immediate, and trust me, it will be violent.
Conversely, let's look at the bullish case, the peace dividend.
Bulls out there are betting that the severe power plant threat, combined with this new proposal, forces a diplomatic breakthrough before the closing bell rings. If a deal actually is struck and the strait opens up, the relief rally will trigger the algorithms, squeezing the S&P 500 rapidly toward that 7,200 level.
Section 4. Steve's closing trading plan.
Look, when the warships are active and the technical indicators are screaming like this, capital preservation is the only trade that matters. Here is your defensive playbook for today. First, respect the 6,800 support. Your 50-day EMA at 6,781 is your primary line of defense. If we lose that level, get out of the way. Do not try to catch a falling knife. Second, watch the CCI. If that needle drops back under 100 tonight, the upward momentum is dead. Third, monitor the oil benchmark. Keep a hawk's eye on $105 on Brent crude, because as long as we trade above par there, the inflation trade owns the ball, and equities are going to suffocate under the weight of those energy costs.
I want to leave you with this final, critical question. Are you trading the headlines, or are you actually trading reality? My advice to you right now, use small sizes, set incredibly tight stops, and whatever you do, do not trust the headline piece until you physically see oil tankers moving through that strait without military escorts. The market doesn't wait for latecomers, and it certainly doesn't forgive gamblers. Stay disciplined, watch your averages, and protect your capital. This is Steve, signing off. Let's get to work.